Well, good afternoon. It is 4:31. We are ready to begin week 6 of our session, an introduction to business. And tonight we're going to discuss 2 chapters. Chapter 17, as you can see on the screen now, which is understanding accounting and financial information. And when we're through with that chapter, then we will move to chapter 18. Financial management, sometimes known as managerial finance. So let's look at our learning objectives for this chapter. Demonstrate the role that accounting and financial information play for business and for its stakeholders. Identify the different disciplines within the accounting profession. List the steps in the accounting cycle. Distinguish between accounting and bookkeeping. They are different, although sometimes some of what they do is very similar. Explain how computers are used in accounting. And also the following: explain how the major financial statements differ. And last, demonstrate the application of ratio analysis in reporting financial information. So we begin the chapter by asking, what is accounting? And notice, without going through that whole definition there, which you can read for yourself, pardon me, and you can also see in the margin on page 464, it is simply gathering information, interpreting that information, and then getting that information out to people who have a need to know. And down here it talks about outside parties. Now, outside parties, notice it mentions employees here, and I know you'll say, and I agree with you, that employees are not outside parties, but this is talking about employees who are perhaps not into that segment of the operation, are not into the accounting piece, they're not into making decisions and a few other things. So it's everybody who has a need to know about what's going on. And it talks about the firm's information, its accounting information. And what this essentially does is tell the outside world, as well as the inside world, but mostly the outside world, the financial health of a company at a particular time. So, for instance, publicly traded companies have to prepare a quarterly accounting statement. And I think it may be called a little something different than what I just said, but they have to have a quarterly statement, and it has to be posted on their company's website, et cetera, and just gives investors, among other people, a snapshot of the company's financial health at that particular time. Now let's look here at some more information. We have what is accounting, which we've just gone through. And then this is the accounting system. And I am sorry, I've lost my ability to blow this up for you. But you can see this graphically displayed, the figure 17.1 on page 465. And what this is, it shows the inputs. That's the information that comes in, and this is different type things, expense accounts, payroll records, and things of that nature. It goes through a processing system or systems. Entries are made, and then journal entries are made based upon that, and then we have accounts being summarized. So you have a couple of different reports are going to be generated here. And then finally, you have the outputs, and we're going to talk about these to some extent. The balance sheet, income statement, statement of cash flow, and then other reports being an annual report or a quarterly report, as the case may be. This shows us what the accountant's responsibilities are. And we have some information here. A lot of these things are in a way self-explanatory, but they take on different meaning, etc. So notice one thing here is on the left-hand side. Now we talk about, talk about this person or persons managing the cash flow and then also forecasting what that's going to be. And then it goes all the way over to things like tax and auditing and things of that nature. So these are what accountants do. You may have different accountants in a large company working on different aspects of these things that we just mentioned here. Managerial accounting, managerial finance, managing finances, etc., is what it does is it takes this information that we have gathered through the accounting cycle, for lack of a better term, and given it to the managers, and in some cases provided some analysis to them. Now, I'm saying in some cases, some may not have an analysis. Some of the information may not have an analysis attached to it. Most of it does, but some may not for some reason. And then often you might find a manager asking not to have an analysis because he or she wants to make his or her own analysis based on the information that's provided. In other words, they don't want anybody swaying them in their analysis of what's being presented. In other words, they're saying that, Mr. and Miss Accountant, please don't tell me what this says. I want to figure this out and I may get back to you and we can have some dialogue about it. So notice what managerial accounting is involved with. Cost of production, marketing, preparation and control of budgets, ensuring that tax liabilities are minimized. Now, please do not think that that means avoiding paying taxes. It does not. It means making sure that we're not being overburdened with tax, for one thing, and for another thing, using the laws that we have on the books to avoid paying taxes when and where possible. Again, not meant to be or to sound like avoiding taxes. And then here are the users of the accounting information that has been gathered by company. Governments, obviously, people interested in the organization, usually any stakeholder, and maybe we may primarily want to say it's the investors. Obviously, people who are running the firm have to know what the financial health is. They need to know that so they can make decisions about where they want the company to go and whether or not certain things have to be done or to be put off, and things of that nature. Now here, say we're talking a little bit more here about financial accounting, and we're going to get into that more heavily as we go through the remainder of this chapter. And remember, we're focusing here on financial accounting and the reports that are produced by people who do the financial accounting. This information, as we have said before, but this slide says it a little differently, is this information is generated for people outside the organization. That doesn't mean the people inside the organization are not going to use it, but it's primarily generated for people outside the organization. I mentioned publicly traded companies have to provide quarterly reports, quarterly financial reports. And what these things are going to tell us is what is the financial health of the organization, meaning, is the organization able to pay its bills? Is it profitable? Does it have too much debt? If a company has too much debt, then it's difficult for the company to attract new finance because it has to pay off this old finance, and that may be burdensome due to the interest rate that it's paying. A lot of times when companies get to this situation, they'll try to restructure their debt, and of course we don't need to go into here, but they try to restructure so they can do a better job of managing the debt, et cetera. But you don't want to have too much debt, because if you have too much debt, then you have problems. Now, there's an interesting thing, and I know that some of you may have read about this and you wonder about it. We have a number of companies in the United States who have significant offshore operations, and they have made money on those operations. If they bring that money home to the United States, they're going to be taxed, and they don't want to be taxed. So they leave that money where it is, and to continue operations in some cases, they borrow extra money. So you're saying, well, okay, here's a company that's sitting on, let's say, $1 billion profit that it does not want to bring back to the United States, and yet it's going out and borrowing $500 million. Why are they doing that? Just for the reason I said. They don't want to pay tax on that, and of course then debt, if they do it in certain ways, is tax deductible. Now, here are the items that we're going to talk to, how you read the annual report, and things you want to look for. One of the things it mentions at the top is the manager's assessment of the financial health of the organization. There is another piece that goes along with that a lot of times, and this is if you have an outside auditor looking at the organization. The auditor is required by law to determine the financial health of the organization, and he or she should so state. This is what happened down at Enron, where Arthur Andersen not only was the auditor for Enron, it was also providing consulting services for Enron. So what happened was you had a conflict of interest, and the auditors should have been reporting something that they saw that was an anomaly, and they didn't. We just saw this with FIFA, the international organization that runs football worldwide. We commonly call that soccer in the United States. They read an article in the New York Times that a number of people you may know have been indicted by the U.S. Attorney General, or by the Justice Department, not by the Attorney General herself, but by the Justice Department. And yet auditors for FIFA have not noticed any irregularities. So there's a dichotomy there. Of course, it could be that the auditors are only given certain things to look at, but anyway, that's something that really is a concern. And then you have the balance sheet, the income statement, the statement of cash flows, and as I mentioned here, the auditor's opinion. And I linked that up with the management. And yes, as they have it here, the auditor's opinion will be separate. But it's important to know that the auditor's opinion is part of this annual report. And it probably should be as important reading as the rest of it. Now, this is just going to take us through the difference between private accountants, public accountants, and certified certified public accountants, also known as CPAs. Private accountant is just somebody who works for a particular firm. Could be government, could be profit, could be nonprofit. A public accountant is an accountant who provides his or her services, or his or her company provides services to an organization. They perform the same type functions. The difference is one works for a company in a company, the other offers his or her services or his or her company services to organizations. Certified public accountants are people who have gone through rigorous schooling. I'll get to that in a second. And then sat for a state exam to become certified public accountant. Now, one of the things I said, rigorous education requirement, is that for the most part, states require a student who, not a student, a person who is going to sit for the certified public accountant's examination to have a bachelor's degree and so many credits above the bachelor's degree. Most of the time, it equals 150 credits. Now, if you stop and think that most colleges and universities require 120 courses to 120 credits to graduate, we're talking about an additional 30 credits. There's more accounting and more auditing that has to be taken. Some colleges and universities offer a program where a student gets into and goes through the whole process where he or she has finished the course of study and is now eligible to sit for the state examination. And while this is done in a state, it is a national examination, but different states could have their own rules of sitting for the exam and the number of courses that have to be taken prior to that, et cetera. These are the ways that to improve accounting practices. And I think it's very important that you see these and just listen to, in some respects, what they have to say. Hire an independent firm for consulting. Now, that firm should be separate from the firm that's going to do the audit. And because you don't want the conflict of interest that happened with Arthur Andersen, which is, by the way, out of business today because of the Enron implosion roughly 14 years ago, because they were offering not only consulting services, but they also offering auditing services. So the auditor ought to be separate from consulting and vice versa. You should also have an internal audit. The internal audit can tell you where you are. Now, by the way, you ought to have people who are trained in auditing, but they do not have to be accountants. Because you do some auditing and doesn't really get into accounting. So you ought to have some internal, and that's bounced up against what somebody does as external. And of course, what has to be required is that the auditors, the outside auditors, I'm talking consultants here, auditors, they have to have free and unfettered access to the organization's books and financial health. This is an act of Congress, the Dodd-Frank Act, named after former Senator Christopher Dodd of Connecticut and former Congressman Barney Frank of the House of Representatives. This act was passed in response to the financial meltdown that we went through starting in late 2007, mushroomed in 2008, that caused the economic meltdown that all of us felt and at various degrees, and some of us are still feeling that. One of the problems with the, well, I don't want to say problems, not a problem. One of the issues that is being faced is that many financial institutions are trying to water down the Dodd-Frank Act. And if they're successful, we may be back in the same jackpot we are slowly crawling out of that began approximately 8 years ago. What happens when we have the type of scenario that we have here is there tends to be, in some respects, I'm going to use the term overreaction, although I don't think that's, maybe corrective action is a better word to use. There tends to be severe corrective action instituted by the federal government. And of course, the people who it's instituted against are instituted to protect them from doing things, or to restrict them from doing things. They don't like to be hamstrung. and they want to do all sorts of things that are neat and wonderful and pretty, but nobody understands. So Dodd-Frank is just increasing regulation and increasing accounting procedures, strengthening accounting procedures is a better way to say that, on financial institutions. And notice they're increasing the power of the Public Company Accounting Oversight Board. Again, much consternation about this, mostly from the financial sector. So far, Dodd-Frank is surviving, but I'm not sure how long it will survive. Now, this brings us to auditing, and it is just the information that's used to prepare a company's financial statements. But auditing can also be other things in an organization. It doesn't just have to be financial. It can be auditing operations. It can be auditing controls. It could be auditing a number of things that really don't get into financial business. But we're talking about finances here, so that's why it says what it says. Independent audit's exactly what it says. Now, there's some issue with thinking about the term independent audit. And I want you to think about this. I'm not asking you to change your mind or anything else, nor am I saying that what I'm going to say is nefarious. It's not. But if I own a company or I'm the CEO of a company and I hire an independent auditor, is the independent auditor now still independent because he or she or that company is under contract to my company to prepare an audit? So in effect, I have hired someone to check my books. And if I don't like what they come up with, I can fire them. So we have to think about independence here and how it's set up. And this is part of the reason we need to have, we haven't talked about this too much, independent as much as possible boards of directors. So, that they are not company employees now that normally find out that the CEO is on the board of directors. But if too many people in the company work for the company or on the board of directors, then we don't have independence and we don't have oversight. Certified internal auditor is an accountant, as it says here. Notice that he or she has a bachelor's degree plus several years of experience, and then they pass an exam developed by the Institute of Internal Auditors. This is the legal briefcase that I'm not going to talk to you about, except you can find it at the top of page 468. I always encourage you to read these and to get some additional insight. Now, there are specialized accountants. Notice here we have people who are tax accountants. Those people we normally see around the tax filing season from January to the middle of April each year. And then we have government and not-for-profit accounting because these organizations are not in the business to make a profit. But they do have an obligation to tell the people that they are serving, or their funders, or their donors, how well their money is being spent. So these people do that. Now we are here to begin the accounting cycle, and we can see that graphically displayed, figure 17.4 at the bottom of page 470. So we're going to talk about these as we go through, but we have analysis, we record transactions, we transfer or post, as it says here, journal entries to a ledger, take a trial balance, prepare financial statements. These are the end things, and then analyze financial statements. Now here is the bookkeeper's role. He or she is to record the transactions and put them in some categories that make sense. And then they're going to post these into a record book, or for the most part today, into some sort of a computer system. And notice it's called a journal. And then we have what is known as double entry bookkeeping. And this simply means the transactions are posted in two different areas. So there we have a check and a balance, if you will. Bookkeepers use things called ledgers. This is a specialized accounting book, or most likely a program, a computer program. And you're going to find all the information you need in one place. Then when they have all the information in one place, they're going to take what's known as a trial balance. And that is just summarizing or giving a summary of all the financial information that's been recorded. Now, this is just a brief step away from what we talked about here. This just lists popular software programs specifically for small business. QuickBooks and Peachtree, and they're set up for small businesses, and they help small businesses get through the process. It's difficult and maybe too expensive for a small business to have an accountant do a lot of this work on a routine basis. Hire the accountant for the annual report at the end of the year, but for the interregnum, they'll take care of their own. Now, we've talked about some of these. The financial statement, again, being a summary of all the transactions, and the three key components being the balance sheet, the income statement, and the statement of cash flow. And again, you can see these listed in the chart in the figure 17.4 at the bottom of page 470. Now, this is something that we need to make sure we have on our heads. It's not difficult, but it's something we need to think about, because this is, as it says here on the slide, the fundamental accounting equation. Assets equal liabilities plus the owner's equity. So the equation must always be balanced, and it includes the fundamental equation of assets equal liabilities plus the owner's equity. The balance sheet simply tells us where we stand financially at a specific date. So it could be a weekly balance sheet, a monthly, quarterly, obviously annual, because that's something that you have to have. If you're a small business and you're a sole proprietor, you're going to report that with your income tax. You may not need to report it separately you may not need to report it separately. It's going to be reported with your income tax, but you may not have to file a separate document or documents. You can roll it up all the same. Obviously, you need to check and make sure you can do that, but you could roll it all up, but there has to be an annual statement of some kind. What are assets? They are different types of things. They can be either tangible or intangible that the company owns, and they're considered an economic resource. Now, if you have a piece of machinery, it's pretty easy to say that machinery is worth X number of dollars based upon its original cost and the depreciation schedule. It's not as easy to say how much your goodwill is worth. But the goodwill is always worth something, and that's an intangible. And many times when you see a public transaction on one small business, or a small business changing hands, it will be for so many dollars and so much for goodwill. And then the liquidity part of this means the ease in which that asset can be readily transferred to cash. These are the different types of assets we have. Current assets, fixed assets, and intangible. We talked a little bit about intangible before. We have an idea of what fixed assets. Current assets, notice those are things that you have that can be converted to cash within a year. Receivables, people you've billed people and they owe you money. That's a current asset. A fixed asset is something that's long-term, usually talks about equipment, buildings, land, things of that nature. And then intangible assets, those are things that you can't pick them up and say, oh yeah, I know what this is worth, but they have value. Some things have fallen, this thing like patents. What's a patent worth? It's very difficult to say that. But then other things that you own, trademarks, and then the thing that I mentioned before, goodwill. Now, we talked about assets, and again, we talk about assets, and we have to talk about liabilities. So we have to classify liabilities. And the first liability is what I, as a business owner, owe to someone else. Call that debt. That's the best way to say that. Accounts payable. This is what I owe for merchandise that I bought on credit. Now, what is credit? Credit can be something that you use your credit card to buy, or it can simply be you were sold some merchandise that you needed, and the terms are net 30 days. In other words, if what you bought is worth $1,000, that's what you owe the person, and you take the entire 30 days to pay, that's an account payable, and you're using the entire terms to pay because it's not beneficial for you to pay off ahead of time. It could be a reverse of that. Somebody could say, okay, you owe us $1,000, we're going to give you a discount, 1% if you pay with cash in 10 days, or sometimes it's even less than, maybe even 5 days. You think about this in a way that when you get a credit card bill or your energy bill or your telephone bill, it will say that you owe $50 today because the bill was generated today, and if you pay within the next 10 or 14 days, whatever it happens to be, you still owe $50. If you go to day 15, you're going to owe $55 or whatever they figure out the interest rate is, or whatever they decide to charge you. So that's account payable. Notes payable are things of money that you borrowed, and you have to pay those back. and they have to be paid back at the due date. And in bonds, we know well, we've not talked about bonds, so we're going to talk about bonds when we get to chapter 19. But a bond has two payments. Pardon me. A bond has an interest payment that has to be paid, and I'll talk about this again next week, that has to be paid at specified intervals. And then it has a face value that has to be paid at the maturity date. Now, the one thing about bonds is, the good thing about bonds is that interest rate, or that interest that you pay, is tax deductible. Now, here's what the owner's equity turns out to be. The amount of business that belongs to the owners minus liabilities. So it's whatever belongs to me minus what I owe. That's my equity. In the retained earnings, that's whatever I keep after I have paid all my bills. And some is reinvested in the business. If I'm retaining that. So that's what we're talking about here. Now we talk about the income statement. And it right there at the middle of the slide, or the top bullet of the slide, it is where we stand. Bottom line, profit, loss, break even, whatever it happens to be. And notice that it's our profit, our break even point, our loss after we have paid everything, and after everything has come into us. Then talks about costs and taxes and things of that nature. And then whatever's left over, I'm just coming down and repeating what I just said. Once we get through with that, whatever's left over, whatever we have, is either going to show net profit or net loss. It could be break even. You're not going to find that too often in a for-profit company. Not saying you won't, but more often than not, you'll find break even with a not-for-profit company. So that's the income statement. Now we're going to go on with more of the income statement. And the income statement, now there's some formulas here, and we need to pay attention and make sure we've got these internalized. Revenue equals minus cost of goods sold equals gross profit. Operating expenses minus operating expenses. All right, let's go through this again because I messed it up and I apologize for that. Revenue minus cost of goods sold equals gross profit. That's gross. We're not done anything yet. Now, gross profit minus operating expenses equal net income before taxes. And then minus taxes show the net income or the net loss. So let's do it again, make sure we have it. Again, I apologize, I messed it up the first time. Revenue minus cost of goods sold equals gross profit. Minus operating expenses equals net income before taxes, and then minus taxes tells us whether we have a profit or a loss. I'll move this down just a little bit. Accounts on the income statement. We have cost of goods sold are manufactured, and then we have gross profit or gross margin. And this kind of goes back to what we just talked about here. Now, cost of goods sold measures the cost of merchandise the firm sells or the cost of raw materials and supplies it used in producing items for resale. It tends to be a little confusing. That's why I read that. So let's do that again. Measures the cost of merchandise the firm sells, or the cost of raw materials and supplies it used in producing items for resale. And then the gross profit, also known as gross margin, but I have to tell you, I've most often heard gross profit. Doesn't mean to say gross margin is not acceptable. It's not an acceptable term. It's how much we earn by buying and selling merchandise. But this doesn't take any consideration into operating expenses and taxes, etc. Then continuing with the accounts of the income statement, we have operating expenses, what it costs us to do business when we open the doors. Now, I mentioned open the doors as a little differently than not opening the doors. Opening the doors are going to take in rent, utilities, salaries, anything else that costs us to operate. So all of that stuff. And then, of course, along with that, we have, let me go back another way of saying, there's another thing known as fixed expenses. And fixed expenses are what it's going to cost you regardless of whether you open your door or not. That's the rent, utilities, and things of that nature that you have sitting there. And that's a cost before you open the door every day. Depreciation is, notice the term systematic. And there's a formula that most people have, and you usually get that from the government or someone else, how much you can depreciate a piece of machinery over its useful life. Now, that doesn't mean to say that the machinery won't continue to operate, but each piece of machinery is given a useful life, and you're allowed to depreciate the cost X number of dollars a year, and there's a schedule for that. And you know, it doesn't mean to say that you can't change the schedule. You can accelerate the schedule if you want, but that simply means that at the end, you can't take more off than what you're allowed to. So if you want to say, I want to take off 3 years in the first year, you can do that. That's understanding that you can't take that off sometime later. This is what's talked about how you do some accounting, first in, first out method, last in, first out method, and however you do that, it doesn't make any difference. You have to be consistent in how you do that, and how you do it will affect the income. So you just have to understand what you want to do. Like some of that comes up in the case we're going to work about Hard Rock Cafe. Skip me there for a minute. Statement of cash flow, activities that are there, operations, investment, and financing. Cash flow is simple. As notice there in the slide, it's the difference between what's coming in the door and what's going out the door. It's as simple as that. Notice that it can be difficult. It is especially difficult for small business, and it is even more difficult for seasonal businesses. This is making ethical decisions. Again, I don't spend any time on this, but I do encourage you to read this because you get some idea about what's going on ethical decision making. It can help you through the thought process, and you can see this on page 481. Now we're going to talk about ratios, and this is a way to determine your financial health. There are four that are known: liquidity, leverage, performance, and activity. The two in liquidity are the current ratio and the asset test ratio. And this is found on the firm's balance sheet. It tells us how well we're able to pay our debts, specifically short-term debts. Leverage ratio talks about the borrowing of funds. And here the key ratio is debt to owner's equity. Very, very concerned. You have to, if the debt outweighs the owner's equity, the company's going to be in some kind of difficulty. This information is also found on the balance sheet. The probability ratio is exactly what it says. It talks about how well people are managing various resources and whether or not they're achieving profits. And the three ratios you see here are basic earnings per share, normally found for publicly traded companies, return on sales, and then return on equity. Again, you'll find this on the balance sheet and the income statement. Activity ratios look at how effectively inventory is being turned over. I've mentioned before, and I'll mention again, if you have a lot of inventory built up, it's costing you money. You have to pay storage. You have to pay utilities to keep it, out without, so it's not too cold, too hot, etc. So this is something that is a concern. If you're doing a good job of turning over inventory, means you're selling what you're supposed to be selling, and you're using what you're supposed to be using to be able to make the stuff that you want to sell. And again, you find this on the balance sheet and the income statement. This is just talking about trying to make accounting rules simple for everyone to understand, and that they should be an international standard. Something that the Securities and Exchange Commission, SEC, is in favor of, but a lot of companies don't particularly care for it, and so there's still a fight going on. It was supposed to have been implemented some time ago and has not been. This gives you a timeline when the SEC wanted to move to the international accounting standards. Notice that last year, large public companies would be required to report. It's still pending an SEC decision. And next year, all companies will be required to report in the IFRS, again, pending an SEC decision. Now, we can understand that we wouldn't expect a decision for 2016 to be ready right now, but we should have seen some kind of decision that was supposed to have been made last year, but has not. So as we conclude ratios, that brings us to the end of chapter 17. We are almost at 5:20, so we will take a break till 5:25 and come back and talk about chapter 18, financial management. Please come back 5:25. Thank you. All right, 5:25. We're back to continue with our final chapter for this evening, Chapter 18, Financial Management. And let's look at our learning goals for this chapter. Explain the role and responsibilities of financial managers. Outline the financial planning process and explain the 3 key budgets in the financial plan. A little bit differently than what we talked about the last hour. Explain why firms need operating budgets. Identify and describe different sources of short-term financing, and we're going to talk a lot more about that again next week. Identify and describe different sources of long-term financing. Again, we'll talk some more about that next week as well. Well, here's the question that's posed here, and I think it's probably a good question to ask since we're in this. What is finance? Or as they have it up here, what's finance? This is what the firm does, and usually there is a person that does this. Large companies will probably be, well, I say a person. Large companies will have a person known as the Chief Financial Officer, CFO, and he or she will be in charge of an office that oversees this, and then probably have a number of other people working with them. But they're in charge of preparing budgets. Now, they do that based upon input from the corporate governance people, although the CFO probably is part of that. Doing the cash flow analysis and then planning for expenditures. They do other things besides this, but these are the 3 big things that we think about. So, all right, that's what they do. What's financial management? It is simply managing the firm's finances well enough so that it can meet its obligations. And it said meet its goals and objectives, but and I guess that's probably a little bit different way of saying it, but meet its objectives is certainly in the same realm. Now, these are what financial managers do. And this would be the CFO, large companies. Some other companies would be a little bit different. Responsible for making sure that bills get paid, making sure that payments are not only collected, but they're properly recorded, making sure that they know and staying abreast of changes in the market. That's for investing purposes and obviously the market in which the organization operates. And then making, and I don't like this next one, assuming accounting accuracy. No, ensuring accounting accuracy. There has to be something in this guy or gal's office. There has to be a person or persons or group that are responsible for ensuring the accuracy of the accounting accuracy, not assuming. That won't work. And these are just different types of people who are different offices within that Chief Financial Officer, financial planner, etc. I'm not going to go into all of this. And this is what financial managers do. This is figure 18.1 in your text, and on page 495. And they do different things here, and you can see them. We've talked about these in a different fashion before, but it's really something that we really need to pay attention to. They do planning. They make sure the auditing is taken care of. They obtain funds that may be necessary. Take care of the budgeting, as we talked about before. Obviously, there's planning that goes into that. as well. And so a chief financial officer or the head of finances in a smaller company will be responsible for seeing that these things are taken care of, and that someone on his or her staff is assigned to take care of all of these. Now, the CFO, him or herself, or the chief financial officer, I used CFO again, but I'm now referring to maybe a smaller company, even though I'm using the same term, will delegate that responsibility, although he or she may want to reserve the planning and the budgeting, or at least the outlines of the budget for him or herself. These are things that worry financial managers, and it isn't something that I really want to go into a great deal about, because you can read this slide as well as I can, and you have some idea of this. But the one I want to mention to you right now that is affecting all American companies today, and especially those that do business overseas, do global trade, and that is the strength of the United States dollar. It has cost companies money. It's cost companies money because people are going to buy fewer product when the cost goes up. And right now, our exports are more expensive than they've been in some years. Now, to give you an idea, when my wife and I were in France 2 years ago. No, we were in France last year. No, we were in France 2 years ago. That's right. And the euro, which is the currency used in France and many countries in Europe, was around $1.38. Now, it might have been a little higher than that, and it might have been a little lower than that. Now, I looked at the New York Times on Saturday, and the euro was trading at about $1.11 to the dollar. That's 27 cents difference. And what percent that is, I'm not going to try to calculate in my mind right now. But that shows you that with the strengthening dollar is going to have some effect on our exports. Conversely, for the consumer in this country, it makes European products less expensive. So there's a yin and a yang with that, but it really hurts our major companies because their profits have been squeezed. But they're still making money, but they're not making the amount of money that they would like to make simply because of the stronger dollar. Three reasons that companies typically fail. Now, while it has this here, and this applies to companies across the board, it's probably more important for small businesses than it is for larger businesses. And the only reason I say that is because larger businesses probably have more controls in place than a smaller business does. So not having enough money, under capitalization, not having good controls over money coming in and going out, and then we don't control expenses very well. And so we don't have a good record of what we're spending and why we're spending it and things of that nature. These are top financial concerns for CFOs on macro level, big picture level. Consumer demand may change. Consumers are fickle. And I'm talking about us. And we may decide to stop buying something. There's a lot of fads around. And fads seldom repeat themselves. There have been a couple, but seldom repeat themselves. And so you just have to figure out, well, I've got to ride this wave while I can and be prepared to get off the wave when it stops rolling. Interest rates. That's a big concern today because For the last 7 years, pardon me, we have had historic low interest rates in the United States. Now, I know that for us, you folks listening to me and myself, we're still paying about the same rate for car loans and home mortgages and things like that. But businesses and what the Fed charges its other banks to borrow money, it's been historic lows. It's been around zero, and that's probably a little bit above zero, but not much. Well, there's pretty good evidence that the Federal Reserve is going to raise interest rates sometime this fall. I read this morning in the USA Today section of the local paper that it may occur as early as September. Some people are concerned about that. That's going to cause bond prices to go up or the interest rate to go up on bonds or vice versa. And the stock market is usually concerned about that. Don't know how that's going to play out, but that is a concern. At the micro level, this level, the internal level, we're concerned about, look at this, cost of health care. Now we know we have the Affordable Health Care Act, and it has put some dent into the continued unabated increase in health insurance premiums, but it hasn't done what everybody thought it would do immediately. And I just mean to say it's not working. I don't mean to say that at all. It is working. Probably not as fast as people had hoped. And of course, we still have a lot of naysayers out there that don't like it, and they're doing everything they can to overturn it. There's a case before the Supreme Court, which will be decided at the end of the month, et cetera, et cetera. Anyway, this continues and continues and continues. We're still going to have problems with healthcare. So there are some things, their ability to maintain forecasts. That's always something that has to be a concern, and then making sure there's enough money. Financial planning. Notice here what it talks about. Sorry to have stopped. Sometimes the picture doesn't keep up with me, or I don't keep up with the picture, whatever the right term here is. But financial planning is both short-term and long-term. Short-term generally tends to be a year or less, where long-term tends to be 5 years, maybe as far out as 10. In some cases, you'll see long-term be 1 to 3 year, and you can find some difference of opinion in that. But we can stick pretty much with short-term of being a year or less. And then making sure that you have the proper controls in place to assure financial stability, and that the organization's achieving what it's supposed to achieve financially. And there's a difference. And we go back to this issue that I talked about a few minutes ago about the exchange rate. Companies projected probably sometime last year, or maybe a little bit before that, what their profit margins ought to be for the following year. And of course, it was based upon how well the dollar was trading against other primary currencies, the euro, pound in Great Britain, and Scotland, Northern Ireland, and maybe some other currencies, the Swiss franc, which is not in the eurozone, the Japanese yen, the renminbi in China, although the renminbi is pegged to the U.S. dollar when in fact it ought not to be. I'm not an economist, but that's a statement that many people in the United States have been saying, who are economists, that Chinese ought to let that currency float, find its actual resting place as opposed to pegging it to the dollar. So these are some things that financial planners have to be concerned about. Now, to help them follow what they want to do, they have to have, as we do in our homes, a budget. You know, we're going to spend so much on rent or mortgage. We're going to spend so much on utilities. We're going to spend so much on food. And then whatever else there happens to be there, what we know are fixed expenses. We have to pay those every month. And then what we have left over is known as discretionary money. And we can do whatever we want to with that money. Well, we can do one of two things. We can save it or spend it. We can't do both. Now, please don't tell me that I have $100 left over at the end of the month and I'm going to spend 50 and I'm going to save 50. So I've done both. No, you haven't. You have not saved all of it and you have not spent all of it. You've split it in the middle. So you can't have your cake and eat it too here. You've spent some and you saved some. So you didn't say, well, I'm doing both ways. No, that doesn't work like that. You can either spend it or you can save it. And so you said, this particular portion I'm going to save and that particular portion I'm going to spend. And you can't reverse the two. Okay. That sounded like preaching. I didn't mean it to be that way. So the budgets tell us what we're going to do and how we're going to get there. Think of them as a blueprint or a roadmap. And they have some parameters and some constraints. Perhaps we like to use the term guardrails. And it keeps us on a straight and narrow, or at least it keeps us not necessarily straight and narrow, but at least it keeps us focused on where we want to go and not get outside those boundaries. So we have to have a solid balance sheet. That's where budgets come from. We talked about what the balance sheet tells us. That it gives us some idea of the cash flow and long and short-term forecasts, etc. So notice here what it says at the bottom, and I used a little bit different term. It says it's a guideline for what we want to do and how we want to go. I use something different, but it's the same thing. And it tells us where we want to go and how we want to get there. Now that's the planning part. This is the difficult part. This is the forecasting. And you remember I talked a few minutes ago about short-term being 1 year or less. And then we have that's the short-term forecast where we think we're going to be. Cash flow forecast, usually done in shorter periods of time. Notice it says months or quarters. A small business probably would want to do it monthly, so it has a better handle on what's coming in and what's going out. May even want to do it weekly, although that might be a little onerous. And then the long-term forecast may go as far as 10 years, as I suggested. Sometimes it's 1 to 3. 5 is pretty common. Now I went backwards here. I beg your pardon for that. Now these are the types of budgets that we have. Normally we speak of 3 budgets: capital budget, cash budget, and then the operating budget. Now let's do the operating budget last, because that's the budget that ties everything together. And it tells us what we're going to do and how we're going to do it and the way we want to go. Pardon me. Components of the operating budget are the capital budget. And this tells us what we're going to spend for big ticket items, machinery, etc. Anything that's going to cause us to spend a fair amount of money. So you can set it any way you want to set it. I mean, the small company, a small to medium-sized company may say that anything over $10,000 goes into the capital budget. Maybe even less than that. I'm just using a figure. Whereas a larger company may not use that dollar figure at all. It may be 10 times that. And then the cash budget, this is just telling us what's going to come in and what's going to go out. Again, during a particular period of time, we talked about month to quarter, and that's what it normally does. We don't go as far as annually with the cash budget. And then the financial needs forecasting, financial planning. We can see this at figure 18.2 at the bottom of page 497. Financial plan, the operating budget in the middle. Again, I'm sorry, I can't blow this up. I've lost my ability to do that. I'm going to have to figure out how to do it. Sometimes when I put slides up here, they don't come in the neat package that I like for them to be in. And part of that's probably, I hate to say this, operator error, which means I'm not paying attention to what I ought to be doing. Short-term forecasting, long-term forecasting, et cetera, capital budget, those are all things that go into financial planning. And notice that all of them stem from, in some way, the operating budget or master budget, whatever term you want to use for that. This is something that we have to have. Cannot operate any company, regardless of its size, without financial controls. And this is just an analysis, if you will, of what's coming in, revenue, versus what's going out, expenses, and making sure that it's within the forecasted budget that we plan for. So you have to have that, and there has to be some way to control some things and how you're going to, what you're going to do with your expenses and how they're accounted for. These are factors that we use to establish financial controls. I say establish, notice they talk about assessing here, but I think we have to establish what we're going to look at first and then use them to assess where we are. So are we meeting our short-term goals, short-term commitments? Are we making enough money? In other words, are we generating a profit? How are we financing our assets? Are we going into debt to do that? Are we selling stock to do that, which is equity? And then the firm's owners, if it's publicly traded, that those are shareholders, are they getting an adequate return on their investment? Now, one of the things we have to stop here, and we'll talk about this in chapter 19, but it's something we need to keep in mind. There is no requirement for any company to pay a dividend. So if you own stock and you say, okay, stock is the XYZ company's $10 a share, I'm going to buy 10 shares, I'm going to spend $100. There's no requirement that company pays you dividends on that stock. A lot of companies do. Some companies defer dividends. Some companies take the profit they make and plow it back into the company. So one of the things that you want to find out about when you invest in stock is whether or not the company pays a dividend, the frequency of the dividend, et cetera. For instance, my wife and I own stock in several companies. There are a couple that pay dividends. There are some that don't pay dividends. And so that's just something that you have to consider. Now, these again are how we have to take care of the funds and what we're going to do and how we're going to do that. We have to be able to manage day to day. And so we have to know what that cash flow is coming in and going out. Even though we only report that on a monthly or quarterly basis, we still have to pay attention to it. we have to make sure that we're not overextending our credit. We have to be able to get the inventory we need to be able to produce whatever it is that we do produce. And finally, we have to make the necessary expenditures to keep the company running. So it can be any number of things that those expenditures, we have to pay attention to those. This is just a financial order or financial martial law. This is in the legal briefcase that you can find on page 501. Something you may want to look at for information. Again, this is dated because this information came in 2011, so it's 4 years old. Of course, we know that Detroit has been in financial distress for some time, so some of it may still be valid, some of it may not be valid, but it's still interesting to look at and read. These are ways you can be more aggressive in improving cash flow. Go after your accounts receivable. Offer them discounts if they pay within a certain amount of time. You can get your money back, which is the next bullet right there. If the vendors have specific sales, you may want to take advantage of that to double up on inventory for a particular item because you're going to save money. You're going to save money, and when you're selling your product for the same price, you're going to see that increased profit there because you took advantage of a sale. Downside to that is you have to be careful that you're going to be able to turn that inventory over very quickly, and you're not going to be storing the inventory and paying money to store it, etc. Raise prices, again, something I really tell you to avoid doing. Not a good tactic unless you absolutely have to. Sometimes you're forced to, but that should be a last resort. And then use credit discriminately. This particular slide saying use, or this particular bullet saying use credit cards discriminately probably speaks more to small companies than it does to large companies. But if we just change that around a little bit and say that credit card, but use credit discriminately, don't overextend yourself, I think that we can make that apply to everyone, regardless of size. This is a making ethical decision scenario. Again, that's not something I ask you to do, but something you may want to look at. You can find this at the top of page 503. Now, there's alternative, sources of funding. The debt funding and then equity financing. Debt funding normally is considered to be buying bonds, at least for large companies, or issuing bonds. I should have said it that way, issuing bonds as opposed to buying them. You issue a bond, you get the person to buy your bond for $1,000 a copy, let's say, and then you say, I'm going to pay 6% coupon, or it has a 6% coupon. That means I'm going to pay you 6% interest for borrowing that money for a particular period of time. So let's say you issued a bond. Most company bonds are long-term, but I'm going to make it short-term so we can all understand it a little easier. So a bond for a year, which usually you don't find, and I'm going to pay you 6% interest, and I'm going to pay that to you quarterly. So I say pay 6% interest to you in the last of March, the last of June, the last of September, and last of December, and then the bond is going to become due also on December 31st, and I have to pay you $1,000 back. So there's an amount of money that's going to be transacted. Now, for the business, that interest payment is a legitimate debt, and that can be taken off on income tax. Equity financing, on the other hand, is just the reverse. This is normally where you're selling stock, or in some way the owners are raising revenue from operations. Notice it says sale of ownership, and that's stock. Now, that does not cost you anything. However, especially in selling stock, if you sell too much stock, then you may no longer be the majority stockholder. So you have to be careful about that, and how much stock you're going to sell, and the type of people that you're getting to buy the stock. Short-term financing just goes back to things we talked about, short-term budgets, money that's needed for a year or less. Long-term financing here, notice again, it's something that's needed for at least a year or more. Now, why do firms need financing? Well, firms need financing just like people need to borrow money for certain things. Now, we were probably all taught by our parents you don't borrow a lot of money, at least I was, and you never took on more debt than what you could pay back in a reasonable amount of time. So companies have expenses, and they may want to borrow money to pay those expenses, maybe through a debt or something, and the interest on that is tax deductible, as opposed to taking it out of operating funds. So they want to deplete operating funds. Or there may have been an unexpected emergency. Or they may have decided to bring in more inventory for whatever reason. And there may be some other type things. Short-term funds. Long-term funds, going to build a new facility, going into new markets, etc. So you may need more operating capital, and the best way for you to do that, as opposed to taking it out of what you have, is to do that, is to borrow those funds. Now, these are types of short-term financing. Trade credit. This is where you buy goods now and you pay for them later. That's where I talked about the term net 30 days. So you bought the goods, you have them in your warehouse, for instance, and you may be using them to make new product or different product, and you're not going to pay for it. It was delivered today, and you don't have to pay for 30 days. So you're going to be using that merchandise to make other merchandise and continue making a profit. And you still don't have to pay. 2%. 30 days. You pay it off in 30 days, you get 2% back. Now, usually what they ask for there is cash. And then a promissory note, you're promising somebody that you're going to pay them X number of dollars on a certain date. Short-term financing. Now, there are difficulties in getting short-term financing, and it's usually very difficult for most small businesses to do that. And that's what the first bullet says. Banks would rather do business with a firm that has a history, that they know does well, that they don't have to worry that their loan is going to be compromised, and they have reasonable insurance that they're going to get their money back, plus the interest. And of course, the next thing is, it's really been difficult for small businesses because of the financial meltdown. Now, that doesn't mean to say that banks still don't lend. They do. It doesn't mean to say that they won't, because also that they do, but it's just more difficult. And that's caused a lot of small businesses to go to other types of funding. We'll talk a little bit more about that next week Chapter 19. But it is difficult, and we need to think that in many cases, maybe in all cases, it is the small business that is a huge driver of the economy in the United States. And banks, in many cases, have lots of money, and they're sitting on it. They just don't want to. They don't want to lend it out, and it's difficult because small businesses need to be able to get money so they can expand. This is of ways that you can, as small business, particularly spotlight on small business, which you can find at the bottom, the top of page 507, talks about different lending sites for small businesses. And it is something that small businesses should take into consideration. Are you going to pay more money? Most likely you will. But the thing is, if you have a viable business and you have a good business plan and you have a good history and you have good potential, you probably can get a loan from these folks. And that's what's happened here with the banks, as we mentioned before, that they don't seem to be willing to loan that money. And this makes it more difficult for small businesses. Different types of short-term loans. First one's a secured loan, and that is backed by some type of collateral. Usually that's considered something that's tangible, like land or some other type of property. Unsecured is just the reverse. Somebody's going to lend you money, and they're not asking for you to put up collateral. Line of credit, that's something you can get from a bank as long as the bank has those funds to make available. And then a line of credit, a revolving credit agreement. It's a line of credit that's like on the revolving scale, I guess is the best way to put that. And it's guaranteed, but it comes with a fee. Well, let me just say this to you. Almost any type of loan, whether short-term or long-term, is going to cost you money. What this says is there's a fee associated with the money it's going to cost you. Factoring. This is a different type of being able to get money. This is where a business, usually a small business, and normally because they're in need of money, will sell their accounts receivable to a factoring organization. What the deal here is the factoring organization will say something like, okay, we'll pay you 90 cents on the dollar. So in other words, if you have credit that's outstanding for $10,000, they'll pay you $9,000. I mean, they'll give you the cash right now. So you have that cash in hand, whereas you wouldn't have it because you're still trying to get people to pay. They charge more than banks. Well, I use 10%, and that 10% is more what banks are charging today. They may charge more than 10%. And the reason that small businesses go there is because they're able to get that money, and the banks won't deal with it. So a lot of times, if you went to a bank in some years past and say, okay, I've got $10,000 in receivables, and I'd like to be able to borrow against that, the bank will let you borrow against that because receivable is considered a guaranteed debt, or guaranteed repayment of debt. That's what I should have said. But of course, that doesn't always happen, and banks just are unwilling to do that today. Commercial paper, notice that this is also unsecured. Usually comes in amounts of $100,000 or more, and it's due to be repaid in 9 months, 270 days. And notice here that because it's unsecured, only financially stable firms are able to sell it. Conversely, only financially stable firms are able to get it. This is one I just say stay away from, credit cards. Credit cards have an enormous amount of interest rate. One of the things that I think most of us do not think about is that when we use our credit card, the company that issued the card, mostly some type of financial institution, is actually lending us money. And if you pay that within the time limit, there's no charge. Now, some cards have an annual fee. American Express, for instance, has an annual fee, and the annual fee depends upon the type of card you have. And then if you have more than one card, there's an extra fee for that second card. I'll give you, for instance, I've had an American Express green card. I'm only using this because there's differences. American Express green card for over 30 years. Some years ago, my wife said, you know, it'd be good if I had a card. And so it's my account, but my wife has a card. It's her name. Our account, the numbers are different, but it's still under my account, and we pay a separate fee for that, although not as much as I'm charged annually. We pay something less than that. Then American Express has different types of cards. They have a gold card, which there's extra perks that come with a gold card, and they have a couple other type things. But anyway, there's a fee that goes with that. Most Visa and MasterCards apparently do not have fees. And as long as you pay within the specified time, used to be you got a month. I think you got 3 weeks today, maybe even less. There's no interest. There's no interest charge. But if you don't pay, there is an interest charge, and it's usually somewhere around 18 to 21%. So it is not something that is easily swallowed. And I'll give you an example. I used to listen to, when I was in the military, I was stationed in the Washington, D.C. area. And I used to listen to a money program on Saturday mornings if I was out in my car. And this goes back some years now, and at least 20, maybe actually more than 20. If you had $1,000 debt on your credit card and you only paid the minimum interest every month, it would take you over 8 years to pay off that $1,000. So you have to be careful about that because interest compounds. So my point is just don't use them to make purchases. Pardon me, if you're in business, unless you know you're going to be able to pay that back. These are ways to get money from your business that you want to start. You can get micro loans. One of the things that and we'll talk more about this, you want to go to, if you're starting a business or you have a business and you want to get some funding, one of the best things for you to do, if not the best thing for you to do, is to go to the local federal building and find somebody from the Small Business Administration. They can get you to the right people and help you out. Anyway, there's things like microloans, there's peer-to-peer lending. Talk to your local banks. You may want to talk to some of your vendors. They may be interested in helping you move past the financial crunch that you're in. Now, I'm using financial crunch here not as in a bad term, or something you want to expand. You want to bring in more inventories, things of that nature. So it's not. I'm not using it as negative. I'm using it as more like as a positive. Well, these are things that you need to do. Financial managers need to think about in setting long-term financing objectives. Where does the company want to go long-term? It has to know that. It has to know the plan. What do we need in the way of money to meet our objectives and goals? And what sources of long-term funding are available? What's going to best fit our needs? These are the 5 C's of credit. The character of the person is trying to borrow the money, his or her ability to repay it. I'm not going to stick with the C's. Is the capital going to be invested, borrowed, going to go back into the company? What is the economy today? Is it good for lending or not? And then what does the borrower have to put up to help secure the loan? A little bit more on the long-term debt financing. Notice 3 to 7 years, sometimes maybe 15 to 20. We need to think about promissory notes. I mean, a promissory note is in a way like a bond because we have a contract here. And I have to pay that money back at the time it's due. And I may have to pay interest as well. And so we need to think about that. And of course, as I mentioned before, having this type of loan, a bond or a promissory note or something, that the interest payment is tax deductible, not the principal. It's just like your home mortgage if you have one. You pay interest during the year, file your taxes at the end of the year. That interest rate is deductible. Principal is not. These are just different types of bonds that a company would offer. Indentured, that's what the terms of the bond agreement are. Secured, we know what that is. There's some kind of collateral that's put up with that. Unsecured, we know what that is as well. There is nothing put up. That's just on the borrower's good name and his good or her good faith. Equity financing. Now, you can get this in a number of ways. Now, we've talked a little bit about this in the past. Sell shares in your company. That's always a way that you can do that. Be careful about that because if you're going to do it, you want to make sure that you're still going to be able to retain more than the majority. Now, why do I say more than majority? We know the majority would be 50 plus 1. Well, why am I saying more than that? Well, what happens is if you get enough people starting to foment, even though you own that 50%, people start raising the devil and you're not doing this right, you're not doing that right, you're not doing something else right. It can cause you lots of trouble. Large minority stockholders can cause big issues for companies, and they need to pay attention to that to make sure that they know how to handle them. So you want to make sure that you have more than the 50 plus 1. Obviously, you can plow the profits back into the organization. That's a good way to increase your equity. You can look for venture capital. I like to talk about venture capital in a way of beware. What do I mean here? Venture capitalists are people that will loan money to an organization, and they're probably not going to loan it to an organization that they don't think is viable. They're not going to loan it to an organization they think will not be able to stay in business for a long period of time. Kind of the same thing I just got through saying. They're not going to look at it if they don't like the long-term prospects or the potential amount of profit, etc. Thing with venture capitalists is they want their money when they want it. And so you have to make sure that it's a good deal for you to take money from a venture capitalist. Otherwise, it may not be a good deal at all. I use an example. I have a very good friend of mine. As a matter of fact, my wife and I are going to have dinner with he and his wife in Philadelphia when I go to the conference this week. And he lives in that area. And he has been in the home security business for as long as I've known him. And 40 years or so, whatever, somewhere around that time. And he and a friend had started a home security business on their own, and they got some money from a venture capitalist, and they did very well. Got to ring the bell on Wall Street one day, opening bell on Wall Street one day, or do the closing bell. I can't remember which one he did. But after a couple of years, the venture capitalists wanted their money, and they did not have enough equity built up in their firm to, pay them. So they had to sell the company. They had to liquidate. That's the only way that they could pay the venture capitalists back and, not go broke. So that's the only point I want to talk about venture capitalists. Don't think of these people as being necessarily avarice, although some probably are. They want their money. They're putting up money and they're helping a company stay in business, maybe expand, et cetera, but they want their money when they want it. And so if you don't have the wherewithal, or don't think you're going to have the wherewithal, the time comes to be, don't go in with a venture capitalist. Look instead for an angel lender, which it's much different. And they are not going to be after the money as quickly as a venture capitalist will be. And there's what venture capitalist is. And notice what the second question there is: when are we going to get our money back? And they're in the business of loaning money and making money. And they're not in the business of waiting for it. So that's one of the questions they ask. Well, there's ever the questions there as well, two other questions as well. But that prime one is, how quickly are we going to get a return on our investment? Get our money back. Here are the differences between equity and debt financing, which you can see on figure 18.6 at the bottom of page 513. If you're going to have debt, the people that own your debt don't have any say in how you run the company, unless, as the slide says, there's been some kind of agreement entered into. Normally that's rare, but of course it could happen. If you sell stock, these folks are stockholders, and yes, they're going to have a say in what goes on. Not in management, direct management, but they do have the ability to vote for the board of directors. Repayment, debt, you have to repay at the maturity date, and you have to pay the interest that goes along with it. Stock doesn't have a maturity date. Payment of interest, already talked about. There isn't any for stock. You do get a tax benefit because on the interest that you have to pay on debt, mostly bonds, you do not have it on stock. And if you pay dividends, there's tax that has to be paid on the dividends. You can leverage by raising funds through borrowing to increase the firm's return rate, cost of capital. You must earn that to meet the demands of lenders, expectations of equity holders, etc. So you have to be careful about leverage, and you have to be careful with the cost of capital. These are the lessons that we've learned from the financial crisis, or at least I hope we've learned. Worst thing since 1929. I've lived through a number of recessions, but nothing like this last one. We had financial reforms of the sweeping variety. As I mentioned earlier, there's still some fussing about that. And the government is going to increase its involvement in and intervention into regulating financial companies. Now, we live in a society that says, let's let the market work itself out. Unfortunately, that doesn't always work in the financial market. There tends to be some shenanigans, and we need oversight. Now we need to think about that. Do we need too much oversight? Probably not. Do we need any oversight? Absolutely. So we have to stop and think about that. I know people don't like the government intruding, but the government is the only institution that's positioned to do this. So we have to think about that. And we have to think about every time banks say, well, no, it's causing something else, and yet they're not paying they're not paying high interest rates and things of that nature, and sitting on money and not making loans. Well, that's enough of my soapbox for tonight. We've reached 6:20. We spent 2 hours here talking about financial accounting and then managing finances. And next week, we're going to talk about using securities for to gather financing, and then we're going to then talk in chapter 20 about money and the Federal Reserve. So I thank you for your attention. The lecture will be uploaded tomorrow, probably by 9:30. And thank you for your attention again. And I'll look forward to speaking with you again next week. Thank you and good evening.